So just like today will be kind of that rare occurrence where we have a supermoon on the first day of spring, we had an FOMC meeting on the first day of spring. I don't know how rare that is, but it's not rare for the market not to do so well on the days that Chairman Powell presents the Fed decision and then that subsequent press conference. And today, in some periods of the day, follow that same pattern. So we're going to break that down to see whether or not this is leading to more bearishness, what red flags there actually are that are out there, and what they mean for our expectations, and one area of the market that gives us a trade opportunity to give us some bearish trades in our active portfolio. So let's go ahead and get started. Today is Wednesday, March the 20th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 first with the market forecast indicator. So here's our weakness, and really 2 days worth of weakness. And let me get rid of these drawings for just a second. Here you can kind of see them a little bit better, and we'll remove that one too while we're at it. That's the current near-term approach. So let's just move. No, I want to remove just that line. There we go. So there's our 2 days worth of declines. We still have a strong bullish posture. Market sentiment is still rising. So, I mean, this hasn't changed the trend by any means. The near-term line has dropped. You know, we had that divergence right here with the lower highs and the higher highs. We have dropped down below 50. The momentum line actually was oversold when we were at the lows of the day, early actually. And then we bounced and retested lows and bounced a little again at the very, very end of the day. So we'll see. You know, we'll see how that the momentum line almost produced a bullish kind of buy the dip signal. Didn't quite get that, but you did get the near-term line down below 50. It might stay another day. That's a very shallow, even for a near-term pullback. That's a very shallow. It's not even 38% retracement yet. Probably closer to 2,800 would have been more ideal. So, you know, it might have another day of the near-term line being below 50. But, you know, the idea is that this is a higher low point compared to the last near-term low. It's between 20 and 50. So we're setting up for a good bullish opportunity in the short term, simply based on that factor alone. Of course, there's a lot more technical indicators we look at, right, besides just that. But just based simply on that, we would expect a short-term bounce. So, you know, again, it kind of puts this little selling in some context. It's hardly been any selling at all. Not even enough of one to get the near-term line to oversold levels like it did over here. So, big grain of salt on this. If you look at the Dow Jones, it gets a little different for some of these others. See, the S&P 500 is to a higher high. The Dow Jones is not. So the Dow Jones actually is much weaker. In fact, is showing a bearish posture again with the with not dark pink shading because we don't have the intermediate line below 50, and it's not below the moving average yet, but it is light pink, so we're bearish, weekly bearish again. Near-term line did not quite get into the upper reversal zone like the S&P did, also down below 50. The NASDAQ actually has better short-term sentiment. The near-term line is not below 50 yet. It's been pretty bullish. You can see, not even, I mean, it was actually up today. The FANG stocks especially have been really holding up well, relatively speaking. So, you know, this weakness, and it is to a higher high, unlike the Dow, but like the S&P. So this weakness isn't broad-based. I mean, well, you'll see here, it actually is kind of broad-based, but it's not, you know, that there's some heavy hitters, especially from a market cap standpoint, that are really kind of helping keep things afloat when you look at the S&P 500 itself. Because on the broad base, you can see the IWM closing below the lows of the last couple of days. It's also got a bearish posture. It is a lot closer to being below 50 than the other indexes. Does not have strong bearish short-term sentiment, but we have had that before. We've had multiple touches of the near-term line being down to extreme lows. So things are a lot more bearish for small caps, and that may be something to keep an eye on. We do have close to having dark pink shading on the Russell 2000. You'll see here in a minute. You know, this, if you look at the moving average line here at 1553.39, I'm looking right under the D at the top of the screen, right there. So you see 1550.39, 53.39. So we did go up a smidgen. So that moving average will actually turn yellow tomorrow. because we are below today an upward trending moving average. Just barely upward trending, but we are below an upward trending. But again, it can turn red within another day or two. That's how weak it is. It's pretty much rolling over. If we were to get another day or two of trading below, then we'd have potentially the combination of a red line with dark pink shading, with the intermediate line falling below 50, similar to what you got over here that led to some sustained weakness in the small cap index. So something we'll watch for in the next by the end of this week. Okay, really quick before we look at some other charts, subscribe to our YouTube channel. There's our logo right here in the bottom right corner of your video. Mouse over that logo, click the red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me, number one, you got something out of the video today. Number two, it tells me that you want us to do the video again tomorrow. It's a quick way to give us feedback. Really easy. You can do it right now while you're watching. In fact, whether you hit the thumbs up or the thumbs down, either way, it's good for us because YouTube likes engagement, and so that's what we're looking for. If you liked the video today, if you thought it was fascinating, either thumbs up or thumbs down, we'll take either one because that promotes us on YouTube according to how they do their algorithms. Also, they like comments. So what stood out to you in today's video? Scroll down to the bottom, comment on anything that you got out of the video today. If people come to see it, they usually check the comments to see what this is all about, and we appreciate any comments you might have on the video tonight. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter in between videos for more content, and finally join our market outlook community on Facebook. Also, remember to like our Market Outlook tweet and Facebook posts as well. You can see them right below the video on the blog. Just hit this heart under on tonight's Market Outlook tweet. Hit that like button, and then click on the image. Takes you to your Facebook account. Again, those things help us because it gets our content promoted more by Twitter and by Facebook. It helps you because it tells them that you want them to push you our stuff every time we put stuff out there. So the more you engage with us, the more they think that you want to hear from us. So that's how we can make sure that happens. Also, remember you can subscribe to our site up here in the top right corner of your screen under Join Market Scholars, and you can participate in our Market Outlook forums. Free to do that. Any questions or comments you have, or reply to anybody else's threads that are started in the forum. And then finally, also our schedule over here to the right, you can see upcoming classes. My classes schedule for the rest is actually my class schedule for the rest of the week, with Brandon out of town the rest of the week. All right, back to the chart, and you can see the kind of neutral candle we're getting. Remember, from a Hakinyashi standpoint, it looks like a neutral candle on the regular, but on the Hakinyashi, it's a pretty bullish candle. So we're going to keep our eyes on that, just like we saw over here on this 1210 candle, how things turn bearish after that. Right there, 1210 candle. See, we were really bearish, though that was a transition. We had that kind of neutral, relatively neutral candle compared to those down weeks, and then it fell off. So, are we gonna? We had all these bullish candles. We had a couple transitions here with another bullish candle here that doesn't look so bullish. Does that mean that we'll get this kind of candle next week before things reverses, like we expected it to occur here? That remains to be seen. So we're going to keep our eyes on that from a technical standpoint. From a 3 green arrow, remember that was kind of the important thing. We have 3 green arrows still. We don't even have one single red arrow on the S&P 500. So we're not close to anything there. But remember the Russell 2000, it is close to getting the red line. Right, it'll be yellow tomorrow, but it's close to getting a red line here, being below a downward trending moving average, and dark pink shading because its intermediate line is rolled over and it's closer to 50 than all the other major indexes. So remember, the S&P 500 peaked on this day right here. This was the day it peaked before things started to really fall off the cliff. The Russell 2000 was already bearish by the time the S&P peaked, the last time things got bearish. So right now you got 3 red arrows in Russell 2000, and it's looking like there's potential that the market forecast for the Russell 2000 will also show that bearish combination of dark pink shading with the intermediate line falling below 50 and dark pink or dark red line trading below a falling moving average. So very important to watch this by the end of the week, because I mean literally it can happen in the next 2 days. So we're going to keep our eyes on how the small caps perform in the next couple of weeks to get an idea of how weak we can expect the S&P 500 to be over the next couple of days, excuse me, to see how weak the S&P 500 might be over the next few weeks. All right, now let's take a look at how the intraday charts are performing here. We go from long term to more shorter term, and you can see volume. We talked about volume, or I talked about in the class yesterday, volume picking up here. The volume yesterday was higher, when we closed, was higher than any of these other days, except for these few that were all down days. Well, here again, we're at 3.35, the 1.5 times on this level. And again, all of these were all bearish days that were all similar volume levels. So, keep that in mind, that volume is picking up. The trading range ended up being about, 3.25 points. We'll see here in a second. It was a lower high. The high, though, was at the end of the day. The low was kind of in the middle, so pretty neutral from that perspective. Despite the fall at the end of the day, we still closed above yesterday's low. So, I mean, obviously things could have been a lot more bearish had we closed down here, but we didn't. Remember, the purple line down here is the open for this week's Hakunashi candle. So we still got a long ways to go before we get any kind of lower shadow. This is the close right now, or close to the close for this week's Hakunashi. So there's the body, and then obviously anything above the body is the upper shadow, and of course anything below the body would be in the lower shadow, and we don't have that. We don't have anything below the body. So, we are still trading close to the 4-week high. We're not anywhere near the 4-week low. This, of course, is on SPY. IWM is a much different story. You can see we are in the lower half of the chart. There we are, trading towards. We're not knocking on the door, but we're trading towards the low of the 4-week range and not close to the high. And unlike the S&P 500, which has this bullish pattern of having the high closer to the right-hand edge and the low on the left of the high, that's a bullish pattern here, to have the high and the low in that order. And well, if you look at the Russell 2000, that's not the case. In fact, the high is on the left-hand side, and then the low is over here closer to the right. So this is a bearish pattern, and you see that for the Russell 2000 on one hand, and you also see it on the diamonds on the other hand, which is kind of the opposite end of the spectrum, the bluest of blue chips of large cap companies. Of course, the NASDAQ composite, this would be the NASDAQ 100, like the S&P 500, even a lot closer. In fact, it got a 4-week high today, a new 4-week high today. So that's what's leading our stocks higher right now is those those big name tech stocks. You'll see here in just a second. Well, when you look at the daily volume and trading range here, you can see again the volume about 84 million, similar to what we saw yesterday. We'll keep our eye on how big volume is in the morning tomorrow. You expect it to be big because of how it, where that 1.5 times the average was on the intraday chart. 84.5 million shares trading. The range was just over average, 3.18, also over 1%. So, a little bit of a bearish volume and trading range. So that's higher than the average there. The volume was also slightly higher than the average. So we're not, again, extremes would be way up here. And we're not in extremes, but bearish volumes would be like 4 million shares trade, or 4 points would be a bearish range. Bearish volumes here right around 125 to 150 million. Those are the kind of days that we don't want to see, because those are sustainable bearish days, whereas the extremes are unsustainable. And of course, volumes that are kind of like this, are barely above the average and barely above the average here. Those aren't, those are typical of bullish pullbacks. Bullish pullbacks are not that big of a deal. They're small, they have low volume, and that's kind of what we're seeing right now. And even from a volatility perspective, we didn't jump up too high. We're not above 15. Volatility is still squarely in the bullish range. It's in the upper half of the range, but it's still squarely in the bullish range. We didn't break back into the neutral zone. So as grim as things might have seemed here, especially at the end of the day on that late pullback, the technicals still aren't supporting that this is anything more than right now, at least, just a short-term, a near-term pullback. Nothing to yet expect more of an intermediate pullback. There is a little red flag with how small caps are performing, but nothing yet that would say, you know what, we need to really lighten up on our bearish exposure because an intermediate pullback is coming right now. Not yet. It will, you know, because it has to. I mean, nothing ever goes up forever, right? So there will be an intermediate pullback, but this might not be it yet. As of right now, the technicals are suggesting, at the moment at least, it's just a short-term, a near-term pullback that could very easily bounce back up into the end of the week. So what do you think? Do you agree with that assessment? Disagree? There's a link popping out in the top right corner of your screen. Click that link. It opens up a poll. Then hit either agree or disagree. Vote on that, that market outlook. If you click disagree, scroll to the bottom and comment. What are you seeing that suggests otherwise from what we just covered in tonight's video? All right, now let's talk about what's driving price action. You can see, it's interesting to see at the bottom end of the four-week range here that you have gold and small cap stocks as your worst performers. Crude oil, not surprisingly, is your biggest gainer. That's what's been driving this move higher in equities. International stocks lately have been outperforming as well, really for most of this four-week period, except for a bout of weakness right there in small cap stocks. But you know, you can see what happened here just today. So if we just look at today alone, let's move over here to just today and look at the 10-minute chart. You can see when the Fed meeting came out, of course, the initial knee-jerk reaction was for equities to go up, but so did bonds. Right? Gold prices went up, the dollar dropped, crude oil rallied, gold rallied, long-term bonds, foreign bonds, emerging market stocks rallied significantly. Everything rallied except for the dollar. Even small cap stocks, which were really lagging behind early, they were down big, along with emerging markets down big. They rallied, but then fell off hard. So they were down more than 1% here. So broad sell-off. You can see the SPY was actually barely down at all, and a lot of that because of the strength in NASDAQ stocks, which have held the S&P up to less of a loss. And you can see emerging markets and developed markets outperformed U.S. stocks because of the weakness in the dollar. The dollar stayed down. Long-term bonds stayed up. Crude oil prices didn't follow the weakness to the downside here late. They didn't follow the weakness to the downside early either because you had some strong inventory data. So really positive results. But remember, commodity prices peak last. So while there has been a very strong correlation between commodity prices and stocks, if stocks ever do roll over, they will typically roll over first before commodity prices do. They'll stay. Commodity prices will hold. Usually bond prices will roll over, and then stocks, and then bonds. Well, bond prices have been actually rising. It's the bond yields, and that's what I tweeted out earlier today. Bond yields are hitting hit a 52-week low today, dropping below 2.6%, a key level that a lot of people have been watching for. Still not through the Fibonacci retracement zone yet, but if we break that 2.5%, there's not a whole lot of support in this area to hold us up. So things are really bearish for yields. Again, this is kind of a reflection of inflation expectations. This is a reflection of economic growth expectations. Both are bearish, both moving lower. We saw that in the economic growth projections from the FOMC today were all lower. The current Q1 estimates are lower. And even the economic surprises from all these different indicators, and we saw yesterday factory orders on a year-over-year rate continue to move lower. We see a similar pattern in industrial production. Well, today was the FOMC forecasts, all projected lower. But in the press conference afterwards, he talked about how great the economy is doing. So it's interesting how the Fed's actions, and you can see here, rate cut odds are now are pretty close to 35% for one rate cut by the end of the year. Highest has been. So 65%. In fact, if you look at the historical values, again, the current level is this level, and you can see, we haven't been to, it's around 65% since back here at the very beginning of the year in January. We had that short, very quick dip before we bounce back up right at the beginning of the year. That was at June 3rd. This June 3rd, we have to look at a daily chart. But if you look at the June 3rd dip right there, that little dip right there, we had really high odds for a rate cut, but then we bounced, and the odds for a rate cut bounced to, or fell. The odds of no rate hike, the odds of rate hike jumped up a little bit, but not to high levels at all. They've quickly fallen back down to minuscule levels. The odds of staying here all year long at current levels are pretty high, but they're dropping. Again, see, that was a quick drop. We had been rallying. That was a quick drop, and it bounced back up. We didn't stay there, but for a day. We're kind of steadily moving lower here. So it's important to keep an eye on as economic indicators as a whole continue to be very negative here and abroad. Negative relative to their estimates, which usually leads to, like we saw in the factory orders, leads to a rollover here. And we, like I said, and we've also seen in industrial production, these are hard data points. These aren't survey data points. These are more hard data points. And they're all still positive, but they're all rolling over, suggesting broader weakness, economic weakness. All right, from a sector standpoint, you can see the sector that really suffered the most from the Fed decision today, not good for our Goldman Sachs trade that we looked at earlier, was the financial sector, really dropping down 2%. The yield curve is dropping close to zero. Some parts of the yield curve are inverted, and that's really weighing down on that sector there. So you can see that's the big outlier. On the flip side, the big outliers to them on the upside was the energy sector. Of course, crude oil doing as well as it did is going to push the energy sector higher. You can see communication services. That's where your Facebook, Google are doing well. But also interest rate sensitive areas, utilities and real estate, they were holding up already because of the weakness in the market, but also in anticipation of the meeting. And they did pretty well. Relatively speaking, they did well. In fact, they have gains because, again, they're interest rate sensitive. Rates fall, those sectors perform well as a proxy for them. Consumer stocks, industrials were weak. Again, Boeing, especially in the after hours, kind of weighing that down. Healthcare down, staples down. And there's your technology sectors kind of matching the market both to the upside and the downside. So you can see the market from a sector standpoint, your interest rate sensitive areas and energy stocks, that's that $1 sensitive area. Because remember, the dollar also is not the yields are not the only thing that suffered today. The dollar also suffered. And it's close again to, it's testing the 200-day moving average again. It's close to crossing to the downside. Again, the sectors that benefit the most from that are the energy material sectors, commodities related, as well as that industrials. Industrials still kind of struggling with the Boeing, with that link to Boeing. The transportation average, the Dow Jones and transportation average looks very different than the industrial average. You can see this is the ETF actually that tracks it, but you can see how while the Dow Jones Industrial is close to, it's up to 260, it's close to its highs. In fact, if you take a look at it on a daily chart, you can see what it looks like here. Okay, we're close to 260 and looking pretty decent on diamonds. But if you look at transportation, not close to these highs, not close to these, and falling, actually retesting those lows already, where the diamonds are still kind of well off those lows. So there's some weakness in transportation, which also is kind of a red flag, similar to the performance we're seeing in small caps. So an intermediate pullback may be on its way sooner rather than later, just not as imminent yet. Because remember, small caps underperformed for a while before the rest of the broad market, the S&P, roll over along with the last time we saw a general period of weakness. One stock that is actually showing some bearish signs, not because of the weakness in the dollar. Usually it should be strong in the strength of the dollar, but bearish signs in terms of economic growth expectations falling. You can see this stock is falling too. It's got 3 red arrows. We're below a falling moving average. This is a Nucor steel. You can see also from a market forecast perspective, you have dark pink shading, dark red line, bearish combination there. We're rolling over from what was a lower high point here on the 3 green arrow chart. You look at its long-term moving averages. From a long-term perspective, we are still in a bearish move. We have tested a 200-day moving average. We were unable to stay above it. We are moving back down below it. Things are looking relatively bearish for this particular stock. You look at the not the linear regression, the Bollinger Bands for Nucor, and you can see we had a lot of resistance in here. Was unable to really get above that, and now we're kind of falling back down outside of the strong volume range to the downside. Falling moving averages, falling Bollinger Bands, and then finally from a DMI perspective, of course, you can see here the negative line, DI negative, is back above 25. Looks like it's highest level here. It has a good chance of staying with the positive line down below 20. You can see from a MACD perspective, when you look at the two lines individually, oops, not MACD, Nucor. We're down below zero. It's easily down below zero. We're below its moving average. Stochastic's crossing below its moving average. Low volume today, so we don't be aggressive. I'm not aggressively bearish here, but you can see there's bearish patterns, and so you have an opportunity to sell call options. Even with April, you still get enough credit here to make the trade worth it. Keep in mind there are relatively big spreads. So the way you account for that is you have to figure out where you're going to get filled in at. It looks like right now we'll get filled in around 48 cents according to the platform, which would be great because 47 cents is 30% return on risk, which would be plenty of risk for a short vertical spread. Remember that you would get out with a $48 loss to keep our losses small if it did rally, and of course the break even is up above the current high point, so we'd have to basically nullify this bounce and get back up and move back up towards here we go, move back up towards what, $60, right into saying $60.50, which would be right up above that blue line, so, and above the moving average for that matter, the 30-day moving average. So it's an opportunity to add a little bearishness to your portfolio, just in case, and a little bit of balance, because we have been making largely bullish trades lately. So here's another bearish opportunity that we can add to give us a little bit of a good mix here, healthy mix. Alright, so that does us for today. Now I want to hear from you. So use that link that's above the video in our blog post, takes you to our forums. Open up a new thread, reply to anybody else's thread. What questions or comments do you have on today's Market Outlook video? Post them there. Other market scholars who watch these can be able to respond as well. But I want to hear what you have to say and what you have to share with the rest of our community. As always, thank you for watching. Have a great rest of your evening. Remember to subscribe to our YouTube channel, give us that thumbs up, and comment on the video. Follow us on Twitter and Facebook, and join our site for free with that link that's on our blog. Have a great Wednesday night, everybody, and we'll see you all tomorrow.